Over the years, I've had a lot of families want to help their kids get a home. And even more so in the recent years because starter homes are so much more costly these days. Real estate everywhere seems to have skyrocketed. And people want their kids to be able to get into a good neighborhood, to be able to raise their family in a good neighborhood. And so they have wanted to help their kids get into a home. I've seen this done a number of ways. I've seen families give a home that they already own to their kids. It could be a rental that they own, or it could be the home that they're living in, and they're now ready to downsize. And so they give that to their child to take over. Now, when you give a home that you already own, you do need to understand that your child will take over your cost basis. And in the future, when they sell the home, their gain will be from the point in time that you bought it, whatever the growth has been, all the way up until the point in time that they sell it. Now, if they live there for 2 of the last 5 years and it's their primary residence, they get to exclude $250,000 per person. So if they're married, $500,000 in total of gain. But if the gain is more than that, then they will pay tax on that gain down the road. And depending on how long you've owned a piece of property, you could already have a pretty hefty gain in it. So it's important to understand that and that they understand that as well. Another way that I've seen people give a home to kids is to use cash to buy a home. Sometimes just give the kids the cash, or sometimes they buy the home and put it in their kid's name, but using their own cash to buy a home for the kids to live in, or to buy part of it. Maybe they're, not necessarily buying all of it, but chipping in a good chunk of that home. Now, in this planning, when you're thinking about giving cash, you need to think about where is the cash going to come from and what are the tax consequences to you to create that cash. Do you need to sell some investments? Do you need to take money out of some accounts where it would be taxable to you when you pull it out? And should you try to spread that over a couple of years, like the end of one year and the beginning of the next year, so that you can minimize the total tax cost to you? On top of that, whether you're giving a home that you already own, or you're giving cash or buying a home, you want to report that gift on a gift tax return. It's most likely going to be that you're giving more than the annual gift tax exclusion amount. And any amount that you give that is over that annual gift tax exclusion needs to be reported on a gift tax return. Now, this does not mean that you have to pay tax on it. It just means that you're going to use up some of your lifetime gift tax exclusion because you gave some of your assets away. The gifts are not taxable to your kids. I get asked that question a lot. Will my kids have to pay tax on this gift? And the answer is no. Gifts are tax-free. But when you give away things that you own during your lifetime, you have to report it so that it reduces your lifetime gift tax exclusion, which right now is almost $14 million. So there's a lot of room before you would have any tax to pay. Now, the third way that I've seen people help kids get into a house, I should say, not actually give it, but help them get into a house, is becoming the mortgage. And you can use a third-party company that structures a mortgage. You put the cash to buy the house, then the kids pay you back with a regular mortgage payment, interest on the mortgage, and that allows them to get into a home without having to get a mortgage from a third party. And this could be a good way to do it if you don't actually want to give away that cash or give away that asset right now. Now, I've seen a lot of people that have done that, done the mortgage, and then make gifts to help pay for the cost of the mortgage, use their annual exclusion to help pay for the cost of the mortgage. And in doing that, you're able to structure it in a way, if you charge enough interest that it qualifies as a loan, not a gift. If you meet the IRS minimum interest rate, then you don't have to use up any of your lifetime gift tax exclusion. If you're just using your annual gift tax exclusion to help cover the payments, that doesn't have to be reported. It does not reduce your lifetime gift tax exclusion, and the loan does not reduce your lifetime gift tax exclusion. So this is a way of helping your kids get into a home without actually reducing your lifetime gift tax exclusion. And if you're wanting to preserve that at the max because of the size of your estate and what you're wanting to leave to your kids later in life when you pass away, then this would be one way that you could go about doing that. So those are the 3 ways that I've seen people help their kids get into a home, and any of those would work. What works for you would depend on your situation, your kid's situation, how much help you wanted to give them, how much help they wanted from you, what your estate looks like, and what you're trying to do for the long term. So you'll want to talk through those issues with your financial planner, with your tax planner, with your estate planner, so that you come up with the very best plan if you are wanting to help your kids get into a home. And so with that, hope that's helpful. Be sure and subscribe, and I look forward to seeing you in the next video.